Question 1. An ecosystem launches a token with a fixed initial supply of 1 billion tokens, but includes an automatic burn function that removes 1% of the transaction fees each time the token is used in protocol fees. Over time, how does this dynamic supply mechanism impact the token economy? A. It inevitably leads to hyperdeflation, causing token hoarding and network stagnation. B. It creates a deflationary bias moderated by usage, a dynamic equilibrium between burn rates and circulation velocity. C. It denies any deflationary pressure because burn happens only on fees, not total supply. D. It guarantees price appreciation regardless of demand due to perpetual supply reduction. Correct answer. B. It creates a deflationary bias moderated by usage, a dynamic equilibrium between burn rates and circulation velocity. Explanation. When a token incorporates a burn mechanism tied to usage, its supply decreases with each transaction, creating inherent deflationary pressure. However, the magnitude of burn is proportional to network activity, so the ultimate supply trajectory depends on the delicate balance between activity-driven burns, new demand, and token velocity. This design encourages sustainable use instead of arbitrary scarcity. Question 2. Which economic framework best applies to modeling the token velocity in a decentralized ecosystem where fungible tokens, FTs, mediate user transactions? A. The Laffer curve for tax revenue. B. MV equals PQ from monetary theory where M is token supply, V is velocity, P is price level, Q is transaction volume. C. Metcalfe's law alone, since velocity is purely network size influenced. D. Zipf's law, because token usage follows power law distribution. Correct answer. B. MV equals PQ from monetary theory where M is token supply, V is velocity, P is price level, Q is transaction volume. Explanation. MV equals PQ quantity theory of money provides a structured way to model token economies. M supply times V velocity equals P average transaction value times Q volume of real transactions. It helps analysts quantify how changes in supply or velocity affect token pricing and economic health. Supplementing with Metcalfe's law can help model network adoption, but doesn't directly address velocity dynamics. Question 3. Ms. Ndongo, a tokenomics lead at an African-based DeFi protocol, designs a staking token where stakers earn yield based on protocol fees. She notices that extreme concentration of holdings by a small group of whales is happening. What is the best adjustment to the token model to align incentives and reduce concentration risk? A. Introduce quadratic reward distribution to reduce whale advantage. B. Shift from fixed vesting to immediate release. C. Convert staking rewards to fiat payouts to reduce on-chain concentration. D. Implement a one-time whale tax on large holders. Correct answer. A. Introduce quadratic reward distribution to reduce whale advantage. Explanation. When large holders capture a disproportionate share of rewards, it undermines incentive alignment, trust, and decentralization. Quadratic distribution makes rewards grow sublinearly. Each additional token staked yields diminishing returns, thereby flattening reward curves and encouraging more equitable distribution. This is a recognized approach in DAO governance frameworks to mitigate voting and wealth centralization. Question 4. If a protocol issues a token with a schedule that halves emissions every 4 years, like Bitcoin, what is the likely economic effect of this design? A. It mimics fiat inflation, causing constant inflationary pressure. B. It creates upper and lower price bands set by protocol design. C. It produces periodic supply shocks, which often create bullish speculative cycles. D. It forces immediate equilibrium in supply-demand balance. Correct answer. C. It produces periodic supply shocks, which often create bullish speculative cycles. Explanation. Having mechanisms, quadrennial or otherwise, are designed to introduce supply rarity at predictable intervals, creating visible supply shocks. These events often lead to speculative buildup and price increases ahead of the halving, as seen historically in Bitcoin's 2012, 2016, 2020 cycles. It's a strategic scarcity tool but brings volatile cycles, not guaranteed equilibrium. Question 5. Which valuation approach is most appropriate for a token that pays out a predictable share of protocol revenue as fees? A. Price to earnings, P/E ratio scaled by blockchain inflation rate. B. Discounted cash flow, DCF, model, treating future fee distributions as cash flows. C. Market multiple comparison to BTC and ETH. D. Metcalfe's law valuation only, ignoring revenue. Correct answer. B. Discounted cash flow, DCF model, treating future fee distributions as cash flows. Explanation. For tokens that redistribute protocol fees, those payments represent real economic returns, making them suitable for DCF valuation, projecting future distributions and discounting them based on risk. While Metcalfe's law provides insights into network effects, revenue-based tokens need cash flow analysis for true economic valuation. Question 6. Mr. Schmidt, compliance lead for a European token launch, is launching a governance token that allows trading and profit distributions. He's told it may be viewed as a security under MiCA and EU law. What should he first analyze to assess compliance risk? A. Token symbol semantics in marketplace listings. B. Whether token grants economic rights like profit sharing or voting linked to revenue. C. Token color schemes in the UI. D. Whether token is ERC20 or native to another blockchain. Correct answer. B. Whether token grants economic rights like profit sharing or voting linked to revenue. Explanation. Under MiCA and EU financial regulations, a token can be classified as a financial instrument or security if it confers economic rights such as profit sharing, revenue distribution, or governance voting tied to financial outcomes. This is analogous to the Howey test. If there's an expectation of profit based on others' efforts, the token likely falls under stricter regulation, requiring compliance steps like prospectus issuance. Question 7. What is a primary regulatory concern when launching a token distribution via an initial DEX offering EDO? A. Smart contract code may not compile on Ethereum. B. Liquidity pools may unintentionally trigger securities like expectations. C. Tokens minted on DEXs cannot be listed on CEXs. D. EDOs are exempt from all reporting requirements. Correct answer. B. Liquidity pools may unintentionally trigger securities like expectations. Explanation. EDOs often involve users locking funds into a liquidity pool with expectations of token price gains. If not carefully structured, these pools can be interpreted as investment schemes, attracting securities classification and regulatory scrutiny. Issuers must ensure non-investment framing, clear disclosures, and avoid marketing that emphasizes financial returns to stay compliant. Question 8. How does implementing a network fee sink, e.g., burning a small percentage of tokens per transaction, influence token velocity and value? A. It increases velocity by encouraging trading to capture burns. B. It reduces supply while increasing token utility, lowering velocity and potentially increasing value. C. It creates no economic impact because velocity is only demand-driven. D. It converts the token into a stablecoin peg. Correct answer. B. It reduces supply while increasing token utility, lowering velocity and potentially increasing value. Explanation. Burn-based fee sinks serve dual economic functions. They deflate supply over time, and they create transactional utility. Users must use the token to access services. As tokens are burned, holders may choose to hold for scarcity, lowering velocity. This combination can lead to support upwards price pressure, assuming demand remains. Question 9. Ms. Tan, a tokenomics advisor in Singapore, is designing an NFT-based governance token with staking rewards drawn from primary sales. She worries the model may fall under securities regulation. What structural design change can help reduce regulatory risk? A. Require staking to be optional rather than automatic. B. Convert the token into a fungible utility token. C. Ensure staking rewards are flat deterministic discounts, e.g. protocol service discount, rather than profit sharing. D. Allow only one staking cycle per year. Correct answer. C. Ensure staking rewards are flat deterministic discounts, e.g. protocol service discount, rather than profit sharing. Explanation. To avoid securities classification, reward mechanisms should align with utility, e.g. discounted fees for stakers, rather than offering variable financial returns. Flat, deterministic discounts clarify that staking supports protocol usage, not profit expectations, thus reducing the risk of liability under Securities and Futures Act (SFA) in Singapore, similar to the Howey test in the U.S. Question 10. Which token metric indicates token holder loyalty and ecosystem engagement, and is critical to monitor as a KPI? A. Fully diluted valuation, FDV. B. Staking ratio, percentage of total supply staked over time. C. Age of wallet in years. D. Token symbol length. Correct answer. B. Staking ratio, percentage of total supply staked over time. Explanation. The staking ratio represents how much of the circulating supply is being held in staking contracts, reflecting token holders' long-term commitment and belief in the protocol. High ratios indicate stake-based support for the ecosystem, reduced circulating supply, low velocity, and strong demand for governance or yield. It's a crucial metric for economic resilience. Question 11. In a utility token model where network usage is required for protocol access and benefits, e.g., API calls, compute credits, how does this structure balance intrinsic utility against potential security classification? A. Tying it solely to usage makes it a security. B. Utility tokens with usage requirements reduce speculation, but require no legal review. C. A token usable only for service costs qualifies as a utility token and may avoid securities designation if not marketed as an investment. D. Any token with network utility is automatically classified as a security unless registered. Correct answer. C. A token usable only for service costs qualifies as a utility token and may avoid securities designation if not marketed as an investment. Explanation. Utility tokens designed strictly for service access, e.g., consuming APIs, computing power bandwidth, typically avoid securities classification, as long as they're not promoted as investment vehicles. The Howey test in the U.S. and securities regimes globally focus on expectations of profit derived from external efforts. Utility ties must be unambiguous and functional, with strong disclosures to avoid regulatory scrutiny. See SEC, MAS, MiCA. Question 12. Mr. Rossi, a GameFi developer in Italy, launches a dual token system, one token for in-game purchases and another for governance. The governance token also accrues protocol fee revenue. He wants to maintain both as utility tokens. What issue arises from this model? A. The purchase token cannot be ERC20. B. The governance token's fee sharing may classify it as a security under MiFID II. C. Governance tokens are unregulated in the EU. D. Revenue attribution doesn't affect classification. Correct answer. B. The governance token's fee sharing may classify it as a security under MiFID II. Explanation. Under EU financial law, MiFID II, MiCA, tokens that provide financial returns, such as a share of protocol revenue, may be classified as financial instruments or securities. This triggers prospectus requirements, investor protection rules, and regulatory oversight. To remain a non-security utility token, governance tokens must avoid any economic entitlement, offering only decision-making rights tied to non-monetary functions. Question 13. When distributing tokens via an airdrop to incentivize network growth, what is a key tokenomic and legal consideration to prevent fraud or misuse? A. Every airdrop recipient must complete KYC. B. Random airdrops always guarantee utility adoption. C. Airdrops must define eligibility criteria, vesting schedules, and tax disclosure obligations for recipients. D. Airdrops should only use ERC 1155 to remain compliant. Correct answer. C. Airdrops must define eligibility criteria, vesting schedules, and tax disclosure obligations for recipients. Explanation. While airdrops are an effective distribution method, failing to define who receives tokens, vesting timelines, and tax implications can lead to regulatory scrutiny, insider unfairness, or perceived pump-and-dump schemes. Proper design includes vesting schedules, eligibility filters, e.g., community participation, and legal disclaimers notifying recipients of their tax and disclosure responsibilities. Question 14. Which of the following classification frameworks is most applicable to distinguishing between a collateral-backed stablecoin and a governance token? A. Both are securities under all jurisdictions. B. Collateral-backed stablecoins are akin to e-money, while governance tokens represent voting rights, not necessarily securities. C. Governance tokens are utility tokens. Stablecoins always require securities registration. D. Both are unregulated in decentralized finance. Correct answer. B. Collateral-backed stablecoins are akin to e-money, while governance tokens represent voting rights, not necessarily securities. Explanation. Collateral-backed stablecoins, fiat or crypto-collateralized, function similarly to e-money or payment instruments, often regulated under payment services regimes like MiCA or EMD. Governance tokens, in contrast, typically represent voting rights and protocol control, not necessarily financial returns. Classification depends on utility, rights granted, and marketing, per SEC guidance, MAS, and MiCA definitions. Question 15. Ms. Patel, a token economist, is evaluating a newer token that performs rebasing, adjusting supply daily to maintain a price peg while incentivizing staking. What is a principal risk to token holders and platform sustainability? A. Rebasing prevents regulatory classification. B. Automatic supply increases dilute existing holdings unpredictably. C. Rebasing tokens can only be minted on Bitcoin Layer 2. D. Rebasing tokens inherently have negative utility. Correct answer. B. Automatic supply increases dilute existing holdings unpredictably. Explanation. Rebasing tokens automatically adjust supply based on price targets, redistributing tokens to wallets without external action. While designed for stability, they can lead to unexpected dilution, harming holders who don't understand the mechanism. This unpredictability affects user trust, token economics, and may require enhanced risk disclosure under regulatory frameworks like MiFID II or MiCA. Question 16. Which behavioral economic concept explains why users might overvalue rare token mints despite low intrinsic utility? A. Nash equilibrium. B. Sunk cost fallacy. C. Availability heuristic. D. Hyperbolic discounting. Correct answer, C. Availability heuristic. Explanation. The availability heuristic causes individuals to overreact to vivid, easily recalled events, such as high-profile, rare NFT mints, leading to irrational exuberance and speculative pricing despite negligible on-chain or utility value. This dynamic is a critical driver behind market bubbles and informs warning signs for tokenomics analysts assessing speculative risk-taking. Question 17. What tokenomic design feature can help align incentives between early contributors and long-term community members, avoiding reward centralization? A. Front-loading all token supply to founders. B. Implementing a vesting curve with decreasing unlocks over time. C. Eliminating vesting to encourage early participation. D. Minting tokens without allocation for future contributors. Correct answer, B. Implementing a vesting curve with decreasing unlocks over time. Explanation. A long-tail vesting schedule allocates tokens progressively to early contributors, but retains a portion for future community incentives, new talent, and ecosystem development. This prevents founders dumping tokens and maintains long-term alignment. It's considered best practice under DAO governance frameworks and investment readiness metrics. Question 18. Mr. Johnson, a US-based token project lead, designs a yield farming campaign in which token rewards come from the company's revenue. He's approached by legal counsel warning that this might trigger securities classification under US laws. What's a key change he should implement? A. Issue rewards based on random lottery rather than company revenue. B. Convert reward payments to fiat instead of tokens. C. Require all participants to stake for 10 years. D. Limit reward issuance to SEC-registered users. Correct answer. A. Issue rewards based on random lottery rather than company revenue. Explanation. U.S. Howey test evaluates whether returns are derived from entrepreneurial or managerial efforts. Yield farming tied to company revenue creates a profit expectation, likely classifying the token as a security. Switching to randomized rewards removes the direct monetary return linkage, reducing the legal risk under SEC rules. Question 19. How does a strong secondary token market lockup strategy affect tokenomic health post-launch? A. It destroys token liquidity permanently. B. It delays selling pressure and gives the ecosystem time to build organic use. C. It guarantees price stability in all market conditions. D. It converts the token into a bond under financial regulations. Correct answer. B. It delays selling pressure and gives the ecosystem time to build organic use. Explanation. Lockup periods on tokens, especially for founders, investors, and advisors, prevent immediate sell pressure post-distribution. This stabilizes prices, aligns long-term incentives, and allows utility-driven demand to grow. It's a widely recognized mechanism in tokenomics and venture capital design, also seen in mixture with vesting schedules for compliance and economic resilience. Question 20. Which of the following token valuation metrics can help identify overvaluation due to speculative behavior? A. Token symbol suffix length. B. Network value to transactions NVT ratio. C. On-chain wallet emojis. D. Amount of stablecoin reserves held by the team. Correct answer. B. Network value to transactions NVT ratio. Explanation. The NVT ratio compares network market capitalization, value, to transaction volume, utility. A high NVT suggests potential overvaluation, much market cap, little real usage, while a low NVT indicates value is supported by economic activity. It's analogized to P/E ratio in traditional finance and is critical for discerning speculative versus fundamental valuation. Question 21. Dr. Lee, a protocol designer, proposes a model where staking rewards are distributed via an inflationary token with no hard supply cap. While the protocol gains TVL rapidly, token price plummets. What is the most likely economic cause of this price collapse? A. High validator fees. B. Incentive misalignment due to uncontrolled inflation. C. Over-reliance on NFT integration. D. Insufficient Layer 2 scaling support. Correct answer: B. Incentive misalignment due to uncontrolled inflation. Explanation: if staking rewards are paid with newly minted tokens in an uncapped inflationary model, this increases circulating supply without guaranteeing increased demand or utility. The result is token devaluation through supply dilution. This is a classic Ponzinomics trap, where short-term staking incentives hurt long-term sustainability. Many projects, including early DeFi protocols, suffered this issue. A proper emission schedule, paired with real token sinks and utility-based incentives, is critical to maintaining price stability and stakeholder alignment. Question 22. What is a primary risk of designing a dual-token GameFi economy, where one token is used for governance and another for in-game rewards? A. The reward token must be a stablecoin. B. Cross-utility between tokens may lead to circular inflation. C. Only one token can exist on-chain. D. Governance tokens cannot be ERC-20 compliant. Correct answer: B. Cross-utility between tokens may lead to circular inflation. Explanation: in dual-token models, the reward token is typically inflationary, while the governance token is intended to be scarce and valuable. If the reward token can loop back into governance or staking yields, it may cause a circular economy where inflationary issuance floods both token markets. Without burn mechanisms, spending sinks, or scarcity controls, this setup can result in runaway token devaluation and user disengagement, especially in P2E plate-worn models. Axie Infinity's original design faced this issue with its SLP token. Question 23. Which token distribution strategy offers the highest community fairness and minimizes the risk of insider centralization? A. Private sale with early investor discounts. B. Dual ICO and IEO offering. C. Fair launch with on-chain proof-of-work mining. D. Airdrop to existing wallet holders without filters. Correct answer: C. Fair launch with on-chain proof-of-work mining. Explanation: a fair launch ensures that all participants can obtain the token under equal and public terms, without pre-sale advantages or insider allocations. When combined with on-chain mining or staking, this model encourages organic adoption and reduces whale concentration. While not perfect, it is preferable to VC-backed tokenomics where early investors enjoy massive returns at the community's expense. Projects like Yearn Finance, YFI, popularized this model, emphasizing decentralized and community-first principles. Question 24. Ms. Rivera, a compliance officer for a DeFi project, notices their native token is being rapidly accumulated by a few early investors. This threatens to give them 60% control in DAO governance votes. What is the best strategic countermeasure? A. Burn excess tokens from the investors. B. Switch to a proof-of-authority governance model. C. Introduce quadratic voting or delegation-based voting to dilute central control. D. List the token on fewer exchanges to reduce access. Correct answer: C. Introduce quadratic voting or delegation-based voting to dilute central control. Explanation: centralization of governance tokens can lead to protocol capture, where decisions benefit whales rather than the community. Quadratic voting reduces vote power for large holders, by making vote weight grow slower than token amount, while delegation-based models, e.g., compound system, encourage wider participation. These methods enhance Sybil resistance and protect governance integrity, which is especially important under DAO legal frameworks seeking decentralized control. Question 25. What role do token burn mechanisms play in maintaining long-term token value in deflationary models? A. They increase inflation to stimulate spending. B. They introduce randomness in token supply. C. They reduce circulating supply, theoretically increasing scarcity and value. D. They eliminate staking functionality. Correct answer. C. They reduce circulating supply, theoretically increasing scarcity and value. Explanation. Token burns permanently remove tokens from circulation, decreasing the total available supply. In a deflationary model, this creates a scarcity effect which, assuming demand remains constant or grows, can support or increase token value over time. Burn mechanisms may be manual, automated via smart contracts, or tied to protocol activity, e.g., Ethereum's EIP 1559 burn model. Effective burning is a strategic lever in tokenomics to manage inflationary pressure. Question 26. Which behavioral factor most contributes to reflexivity in token price cycles? A. Supply chain bottlenecks. B. Arbitrage limitations. C. Positive feedback loops of price, hype, and user belief. D. Proof-of-stake validator latency. Correct answer. C. Positive feedback loops of price, hype, and user belief. Explanation. Reflexivity, a term popularized by George Soros, refers to a feedback loop where rising prices attract more buyers, boosting sentiment and driving prices even higher, until the loop breaks. In tokenomics, price surges often trigger FOMO, media coverage, and speculation, amplifying buying activity regardless of fundamentals. This dynamic contributes to speculative bubbles, followed by sudden collapses, as seen in Luna and other high-flying tokens. Question 27. Mr. Kobayashi, an advisor to a decentralized insurance DAO, proposes using an NFT badge system to weight voting power based on long-term participation. However, newer users complain this favors early adopters. What principle must be balanced in this system? A. Progressive taxation. B. Governance symmetry and stakeholder equity. C. Token emission optimization. D. NFT standard compliance. Correct answer. B. Governance symmetry and stakeholder equity. Explanation. Using NFTs as governance credentials can strengthen long-term alignment, but may alienate new users if early adopters retain disproportionate power. This raises issues around stakeholder equity, which in decentralized governance must account for both early contributions and future growth participation. Solutions may include dual-weight systems, vesting governance power, or decaying vote rights, aligning with DAO principles of open and equitable control. Question 28. Which tokenomics model attempts to minimize token velocity to preserve value and incentivize holding? A. Free-floating utility model. B. Inflationary emissions-only model. C. Staking and lock-in incentives with yield. D. Zero-fee transactional design. Correct answer. C. Staking and lock-in incentives with yield. Explanation. Lower token velocity, i.e., less frequent movement, tends to support token value by creating artificial scarcity. Models that encourage staking, locking, or timed emissions discourage fast circulation, helping prevent sell-offs and promoting long-term holder behavior. This is vital in building sustainable token ecosystems, especially in yield-based DeFi or governance-heavy projects. Question 29. In a project where tokens are used for DAO voting and liquidity provision, what is a key design risk if tokens are also staked for yield? A. Voter anonymity increases. B. Governance power may concentrate in high liquidity providers. C. Gas fees reduce token utility. D. Token becomes non-compliant under EVM rules. Correct answer. B. Governance power may concentrate in high liquidity providers. Explanation. When LP tokens or stake tokens are used as a basis for governance voting, those who stake the most or provide the most liquidity may dominate decision-making, creating a centralization risk. Unless mitigated with voting caps, quadratic voting, or token delegation, this can erode DAO legitimacy and introduce whale capture, especially in ecosystems where financial capital equals governance power. Question 30. Ms. Zhang, an analyst evaluating a DAO's treasury, notes that 80% of its assets are held in its native token, which recently dropped 40% in price. What best practice should she recommend to reduce treasury risk? A. Increase token burn rate. B. Diversify holdings into stablecoins or liquid blue-chip assets. C. Freeze all treasury outflows. D. Launch a new token with higher FDV. Correct answer. B. Diversify holdings into stablecoins or liquid blue-chip assets. Explanation. Holding the majority of a DAO treasury in its native token exposes the organization to price shocks, undermining financial resilience. Best practice recommends treasury diversification into stable assets like USDC, ETH, or top-tier tokens, using OTC swaps, liquidity pools, or protocol-owned liquidity strategies. This ensures operational runway, ecosystem incentives, and long-term viability, aligning with guidance from projects like Balancer, Uniswap, and MakerDAO.